Well, thank you very much. My name's Kevin. I'll be your economist this evening. If you don't know what an economist is, we like to say just think of an accountant and then subtract the glamour and the sex appeal. I teach economics at Drexel. I'm a professor there, so there will be some charts and numbers. I know after a long day that's probably not what you're in the mood for, but I promise you there won't be a test at the end of it. So I'll try to move through it at a fairly clipped pace and try to keep it as interesting as possible. Yes, I was going to ask if you could turn the lights off down here. So that looks a little better now, right? Not as much of a contrast. So I've been asked to speak. I publish a regular quarterly report on the state of Philadelphia's housing market. It's on Drexel's website. If you just do a search on my name, Kevin Gillen, housing, Drexel, you'll find it. It's very easy. You don't have to register or anything. You'll find it. Just click and download the slide deck. And then I modify my report every time I do these presentations on the state of the market to include some extra material on sort of the current outlook of the market and whatever hot topics might be the topic of the day. Like right now, there's a lot of legislation being considered by Philadelphia City Council regarding our housing market. There's the mayor's affordability plan. There's several bills that will make it more difficult to not only evict tenants, but to hold landlords more accountable and things like that. But I'll start with the market. So without any further ado, let's jump into it. So this is the structure of my standard presentation. I'll start with the general market overview. We're going to start at the 30,000 foot level and talk about the macro drivers of the housing market. So what drives the housing market on the demand side, what drives it on the supply side. So we're talking about things like employment, interest rates, the cost of construction, things like that. Then we're going to dive down into the micro aspects of the market. So what's actually happening in the housing market? What are rents doing? What are vacancies doing? What are home sales doing? What are house prices doing? What's happening where? Things like that. Then I'll talk about, like I said, I always include some extra material on just current hot topics. One of the most common questions I get asked during this presentation is, are we in another housing bubble? I think we are headed for we already know that we're in a soft spot. I think we're headed for a downturn, but I don't think we're in a bubble. So I'll try to convince you that it won't be as bad as the last one was roughly 15 years ago. What can you expect and what can you do going forward? The real reason you all came here is to have some takeaway intel, what you can do with your own practice and your own businesses. And then I'll wrap up. I'm going to skip Trump's tariffs and housing. We don't have enough time. Then I'll just wrap up with some closing thoughts. So without further ado, let's jump into it. We'll start with the market overview. So we'll start with the demand side. What drives the housing market on the demand side? Well, population, jobs, and income are the big three. We'll start with population. This chart here shows the cumulative population growth by MSA. MSA means Metropolitan Statistical Area. It's a federal government designation. Basically means a city plus its suburbs. So the Philadelphia MSA is Philadelphia County plus all the surrounding counties in Pennsylvania, northern Delaware, and South Jersey. Okay? So this shows, going back to 2000, total population growth in each of the 5 biggest metros, including ours. I break out Philadelphia City, Philadelphia County separately. That's the red line that you see down here. So the teal line, the light blue line is the entire Philadelphia metro area. Orange line is Baltimore. This brown line is the New York metro. And then this purple line up here is the Washington, D.C. MSA. Okay? So if you think of it as running a horse race between the 5 major biggest cities here in the Northeast corridor, you can clearly see where Philadelphia comes in and who comes in first, right? Washington, D.C. first, Philadelphia County, the city that we're in, comes in last. You can see COVID right here in 2020. See the dip in Philadelphia? Notice that our population here in Philadelphia is still just below its pre-COVID levels. We didn't lose a lot of population here in Philadelphia during COVID, only about 1.5% to 2% of our population. The problem was it was the 1.5%, 2% you don't want to leave. It was the icing on the cake. It was your millionaires who live in center city condos, okay? Now, so what if it's only 1% of our population? They maybe only be 1% of the population, but they probably constitute about 25%, 30% of our tax base. That's who funds Philadelphia. It's basically rich, retired people. They don't have kids in the schools. They don't generate crime. They don't generate trash. They don't calling the police all the time. They're not using public services. They basically keep to themselves and pay lots of taxes, okay? So when you lose that part of your tax base, even though they may be a small percent of your population, it really impacts your city's revenues and hence public services that we get here in the city, like snow removal, for example. Notice that everyone sort of took a little dip during COVID. New York has basically caught up to where it was. Baltimore and the metro area, the suburbs actually gained population during COVID. The blue line is the MSA. Notice that Philadelphia County went down, our suburbs went up. The millionaires that left Rittenhouse Square, they went to the main line, Jersey Shore, places like that. D.C. barely got nicked by COVID. And in fact, D.C.'s been doing very, very well for the past 25 years. It used to be 25 years ago, the top 10 wealthiest zip codes in the United States were in New York or L.A. Now the top 8 of the 10 wealthiest zip codes in the U.S. are in the D.C. metro area, Northern Virginia and suburban Maryland. Okay, that's how wealthy D.C. has become and how much it's grown. All right, but I show you this because Population is one of the big drivers on the demand side of the housing market. Basically, you show me an area that's growing in population, I'll generally show you an area that's growing, it has a robust housing market. All right, next slide. So that's what population is doing. Oop. Let's talk about jobs. Again, you show me an area that's just like population, you show me an area that's growing in jobs, I'll generally show you an area that has a growing housing market. This is the same 5 metropolitan areas, same colors for the lines, but this time I'm looking at cumulative job growth going all the way back to 1990. Okay, so again, Philadelphia is the red line, DC is the purple line, the Philadelphia metro area is this blue line right in the middle there. You'll notice these lines have a lot more noise in them. That's because jobs are measured monthly as opposed to population, which is measured annually. So we have a lot of seasonal fluctuations in jobs because a lot of jobs, as you know, are seasonal, right? The holiday time, people take jobs in retail, summertime, maybe some people take jobs in agriculture, stuff like that, part-time seasonal jobs. But you can clearly see COVID, remember the quarantines, how much fun they were? And job plummeted because the unemployment rate went up. So that's the ding everyone took from COVID. Thankfully, unlike population, Philadelphia has recovered the jobs it lost during COVID. But again, that's because the people that we lost were retirees. They were wealthy, but they weren't working, so they're not counted in the job stats. So even though we lost population, even though we've regained back all the jobs we lost during COVID, we haven't regained back all the population because much of the population that we lost was wealthy retirees, okay? But thankfully the jobs have returned, and clearly you can see how almost everyone has snapped back since COVID. I mean, that recession was actually a very sharp and severe one, but it was a very, very short one as well. And as you can see, almost everyone is back to their pre-COVID levels, almost everyone. From where they were. So population still hasn't quite recovered here in Philadelphia, but thankfully jobs have. But notice that unfortunately, we tend to lag the rest of the country when it comes to job growth. We are, unfortunately speaking, an underperforming metro area. Notice that even during relatively good times, like the 2000s, I mean, they were growing in jobs, especially DC. Look at DC in the 2000s, and then even in the teens. Whereas look at us. You know, yeah, we were flat in the 2000s, flat in the 90s, the 2000s. The teens, we started to uptick. We had some nice numbers here in the late teens. We all got dinged by COVID. But again, our problem really in terms of jobs isn't so much cyclical. That is where we are in the macroeconomic cycle. Our problem with jobs here in Philadelphia is structural. No matter where we are in the economic cycle, we tend to underperform for the very simple reason we're a relatively high tax, high cost city. Okay? Next one, current unemployment. So again, jobs, population. You show me an area that has high unemployment, or I should say low unemployment. And again, I'll show you someplace that has a robust housing market. Again, unemployment numbers are monthly, which is why there's so much noise in this. Again, most of that's just seasonal static. But this is the percent of the population, percent of the working population that's unemployed. So clearly you can see how this moves with the macroeconomy. So this goes back to 1990. Unemployment went down because of the boom of the 90s, right? There was the recession of the early 2000s. There was the tech bubble in 9/11. You see unemployment going up. Here's the recovery in the 2000s. Then the housing bubble burst, and there was the Great Recession. You see unemployment here in Philadelphia County was up around 11% during the last series, during the Great Recession. Here's COVID, of course. Unemployment in Philadelphia spiked at around 16% back in 2020, and here's where we are now. Right now, unemployment across the board, across the country, no matter where you are, is roughly around 4%, which most economists consider sort of the natural rate. Now, you might say, well, why isn't it 0%? The reason being is that no matter how well or how poorly the economy is doing, there's always some people that are not in the workforce by choice, right? You go back to school, you take maternity leave, you go to write the great American novel, you just want some time off, I mean, you know, whatever, pick your reason, okay? Some people, so there's always some positive number in unemployment, no matter how hot or cold the economy is. Most economists consider 4% the reasonable number. That is, once unemployment drops below 4%, that triggers inflation in the economy because labor is one of the key inputs to producing anything, right? You need people. I mean, AI and robots, I know. But still, for the most part, you need people. When unemployment drops below 4%, usually that wages start to go up very, very fast. Now, that's good for workers. It's bad for bosses and employers because it means their cost is going up. They try to pass that cost on to consumers in the form of higher prices. That's what happened immediately after COVID during the Biden administration. So when unemployment drops below 4%, the Federal Reserve gets very nervous. They start becoming very, very worried about inflation. So they may be good for the labor market, but it can be bad for the economy in the intermediate term because it can cause prices to go up. And when prices go up faster than incomes, that's the very definition of inflation. I mean, if prices are rising faster than your salary is, that means you're losing ground, right? You're losing ground, even though your actual income may be going up. So that's why economists like to look at this. So right now, a lot of people are concerned about interest rates. When's the Fed going to lower rates some more? If this keeps dropping, the Fed will not lower rates. If this starts to go up, the Fed will lower rates. That's one of the reasons we watch this, not only for interest rates, but we also watch it to look where we are in the general housing cycle and economic cycle. Okay? Next slide. So speaking of employment, let's talk about how employment in our region is structured. Okay? Who's working where here in the Philadelphia metro area? This shows the structure of our region's employment. This table has the top 10 employers in the Philadelphia area, okay? So who do we have? We've got Penn Medicine, Jeff Health, the U.S. government, the city of Philadelphia, CHOP, Giant, a grocery store, Temple University in Health, School District of Philadelphia, American Airlines, and Comcast, okay? 8 of our biggest employers here in Philadelphia are either government or healthcare or universities. Those are the big 3. So we like to say our region's economy rests on eds, meds, and beds, right? Higher educational institutions, healthcare institutions, and hospitality, hotels, and convention, and tourist traffic. Those are our big 3. Our economy used to be manufacturing based, but it's been a long time since we've been the workshop of the world, not since, say, the 1950s. We are now a service-based economy, and those are the 3 industries our services are concentrated in. We are America's 6th, 7th largest city. But again, I mentioned how we tend to underperform. Another way we underperform is for a very large city, we have very few corporate headquarters here. We've got Comcast. It's the only major publicly traded company that is headquartered in Philadelphia. If you go to Houston, it's about the same size as us. If you go to Houston, they got about 20 publicly traded companies headquartered there, and they're names that you would know. A lot of energy companies like Exxon, things like that. But airline companies are Texas, Florida, Arizona. That's where a lot of corporate headquarters are relocating. American Airlines is one of the biggest employers, but they're not headquartered here. They're headquartered in Fort Worth, but we know why they're here. It's because of the airport. We're a hub for American Airlines. So that's who employs us. Now, there's lots of other employers here in Philadelphia, but those are the key ones because those are the ones that would attract people from outside our region to relocate here. No one relocates to Philadelphia to work in a bodega, but you would if you got a job with Comcast, right? So that's why we follow the top employers. They're the highest paid, and they're either the ones that attract people here, or we export our services and goods to other parts of the country, right? Comcast is rich because their base is not just, their viewers are not just here in Philly, it's national, right? They're just headquartered in Philly. So that's why we like to watch the top 10. But we are not very well diversified as a region. We are over-concentrated in 3 key industries. Now, the good news, the bad news for that is that your employment base should be like your portfolio for your finances, right? You know how you have to have a diversified portfolio? Well, that insulates you against shocks, right? Fluctuations in the market or the economy. Same thing with your employment base. You want to have a diversified employment base to insulate you against fluctuations in the economy. The good, even though we are concentrated in 3 key industries, the plus side of that is that these are very stable industries that are counter-cyclical, as we say in economics. Meaning that even when the economy is doing poorly, those industries tend to do well. So think about it, right? If you lose your job, how many people go back to school to get a degree, right? EDS, that gives you EDS. Meds. So tell me, if you lose your job or become unemployed or whatever, your finances take a hit, what are you going to cut back on first? Vacation spending or healthcare spending? Vacation, right? No matter what you do, you're going to find a way to come up with paying for those meds, right? No matter how poor you are, how desperate, whatever your situation, if it's a difference between life and death, you'll try to come up with a way to pay for your healthcare, your prescriptions, what have you. So then the third one is beds. Now you might think hospitality tourism is actually very cyclical. But remember, during downturns, what do a lot of people do if they don't go back to school, particularly if you're a little bit older to be going back to school? You start networking like crazy, right? So you go to conferences, you go to conventions, beds. Well, you got one of the biggest convention centers in the country right here. So believe it or not, during our downturns, convention traffic actually does help to make up for what we actually lose in tourist traffic. So point is, we may not boom as much during the boom times here in Philadelphia, but we don't bust as hard during the bad times. Or as I like to say, we don't party as hard when the party's going, but we don't have as nearly a bad a hangover the next day like other metro areas do, okay? So when you're going into a soft spot, it's good to be in Philadelphia. When you're going into an upswing, you want to be in Austin. But right now, we're in Philadelphia, so we're going to stick with that. Like I said, but the plus side is when other places are busting, we tend to have a soft landing. And here's something to convince you of that. This chart is brand new. It just got released today by a company called Johns Burns Consulting. This compares current job growth by category. So we've got things like finance, trade, education, government. That's what each of these columns are. And it's filled in with green if that sector is growing faster than normal for that metro area, red if it's shrinking, and yellow if it's growing or just stable, growing slower than normal. So basically right now, the more green boxes you have in your metro area, the better you're doing right now in this softening economy. So guess who's number one? You see. It's not just the Eagles. Well, they used to be. So we're doing number one right now because we're in a soft spot right now, or we're entering into one. Now, if I showed you this back in 3 years ago, we would probably be down here. Look who's last. East Bay area, that's Oakland, and San Francisco. All right? They've got their own problems that have nothing to do with the housing cycle. It has to do with how they're run as a city, okay? Crime, homelessness, things like that, okay? But you can see where we are, you can see where they are. But again, notice the other cities that are also in the soft spot near the rankings. We see Dallas, Denver, Austin, Washington. Those are all cities that, are, generally speaking, are outperforming us. But right now, they're underperforming because, again, they boom during the boom times. They get overbuilt, they get over-leveraged, they get overinvested. We generally don't have that problem here. So right now, we're number one. Our employment composition, eds, meds, and beds, is currently favoring us and thus helping to support our housing market. Hourly earnings. So I talked about population, jobs. I'll talk about income. That's the other big demand side driver. Show me an area that's growing in income, and I'll show you an area that's growing in house prices. So again, we've got the 5 major metro areas here. I'm showing average hourly earnings going back to 2011. Again, the red line is Philadelphia County. The blue line is the Philadelphia metro area, including the suburbs. Purple is DC. And again, you can see no matter where we are in the cycle, Philadelphia tends to lag the other metro areas in terms of wages. Average wage here in Philadelphia is about $35 an hour. In the Washington, D.C. metro area, it's $45 an hour. And in New York, the gray line, you can see it's about $40 an hour. Well, you ever wonder why house prices are so much higher in D.C. and New York than here? That's one of the reasons. They're wealthier cities. The average salary there is higher. They can support higher house prices. And if I put San Fran on here, it would be like way up there, okay? But the plus side of that is that even though we are a relatively poor city, we have the largest poverty rate, highest poverty rate of any large U.S. city. About 20% of our population lives under the poverty line. It's the highest of the top 10 largest U.S. cities. Silver lining of that is that we're relatively affordable compared to a lot of other cities. Median house price in Philadelphia right now is about $270,000, okay? You couldn't buy an outhouse in San Francisco or New York for $270,000, okay? You'd be lucky to rent a closet for that. Quality of our house, of that $270,000 house, may not be the best, but you can afford it. So we have that going for us. So that's the demand side. Where demand meets supply, we have interest rates. I like to think of interest rates, as I tell my students, it's the price of money. Interest rate math can get complicated, but if you just think of interest rates as the price of money, it sort of becomes clear. More specifically, interest rates are actually the price of credit, but the price of money helps. So this is the 30-year fixed. This is the interest rate most people are going to pay on a mortgage, going back to 2015. The gray bar is COVID and the recession. Prior to the COVID, interest rates on a mortgage were about 4%. They really dropped after COVID because we had a recession. You were down under 3%. And then, of course, we had the inflation years. The Fed had to hike rates. They were up around 8% back in 2023. They've been declining slightly since then. They've been bouncing around between 6 and 7% for the past few years. Recently, there's been some easing. We're close to 6%, but we'd like to see them drop some more. Well, when I address the realtors, this is their main pain point right now, is low inventories and high interest rates. They want to see inventories up and they want to see interest rates come down to get a lot of buyers and sellers off the fence back into the market. Right now, a lot of the buyers and sellers are in a holding pattern because of this. I'll get to sales later. And when I talk to the home builders, their pain point is also, one of their pain points is also interest rates, but not because of home buyers. It's because that's the interest they have to pay on their construction loans. And right now, basically, as you know, in Philadelphia, we've gone through a building boom, primarily apartments. You've seen them all go up, particularly in the neighborhoods surrounding Center City. And so, of course, some up here in Mount Airy, Germantown, Chestnut Hill. But basically, right now in Philadelphia, in our apartments segment, we are absorbing a lot of that new inventory. So that market, that segment of the market is kind of soft right now. And the builders right now are basically all in a holding pattern until either interest rates come down or we enter another upcycle. As one builder told me recently, if your project right now in Philadelphia is not out of the ground, then basically you're waiting until the next cycle for your next project. So the builders right now are positioning themselves right now to acquire parcels, assemble parcels. They're not breaking ground right now. They're trying to get the projects that they finished to get fully sold and leased up while they're looking for new opportunities to break ground in another year to two. Okay, so that's where the segment is. And until these rates come down, we're not going to see another construction boom or housing boom here in Philadelphia or anywhere else. We want to get, I would think, at least down to like 5% before we can really see another upcycle. But as I'll point out later, we're going to go through a soft cycle, but that has a silver lining too because we need to absorb a lot of the new inventory that's out there. So another thing that is on the demand side is consumer sentiment. So real estate, and especially housing, is unique among assets in that the decision to buy or sell a home is as much an emotional, personal one as it is a business one, right? I mean, no one buys a stock or a bond or speculates in currency just because they want to put the certificate on their wall. But you buy a house to live in, right? It's as much some place to enjoy as it is an investment. Well, when consumers are feeling nervous or bad or pessimistic, they're not really much in a buying mood, right? So the University of Michigan actually surveys U.S. households every month. They do several thousand households, asking them on a scale of 0 to 100, how optimistic or pessimistic are you personally feeling about your own personal financial circumstances for the next year? Not how you think the economy will do, how do you think you personally will do? Scale of 0 to 100. 50 means you're neutral. You're neither optimistic or pessimistic. The further away from 50 you are, the more households are optimistic than pessimistic. The further below 50 you are, the more households are bearish rather than bullish. All right? So you can see consumers were in a pretty bullish mood right up until COVID. We actually hit 100, and we've been trying to recover ever since. So big hit during COVID. Then we had, some other stuff going on. We had the inflation in the economy. That's leveled off. So, there's some bouncing around. Right now, consumer sentiment is hovering right around 60. So 60% of American households are more optimistic than pessimistic. That's good, but it's not great, okay? So still there's a hangover from COVID and probably some other stuff from the past few years like the inflation and other things. But we want to see that orange line come back up before consumers really feel confident enough to commit to making, what is for most people the biggest purchase and biggest financial investment of their lives. So that's consumers. Let's look at home builders. So the National Association of Home Builders, which is the primary organization representing the home building industry in Washington, publishes a similar survey. Every month they survey their members. I'm actually a member. On a scale of 0 to 100, they ask the home builders how are they feeling about their own personal business, not the home building business, not the general industry, but their own personal home building business over the next 12 months. Same thing, 0 to 100. During the Great Recession, the housing bubble, bust, home builders were nearly suicidal. I mean, they were down around 15, okay, was the average reading on their index. The teens were pretty good to the builders. The home builders really took it on the chin during COVID, all right, because basically, remember the quarantines, they couldn't show any homes, construction was frozen, but in the meantime, they were still paying interest on all their construction loans, so they were in dire straits. They rebounded, then inflation hit, and you can see they've been sort of down in the dumps for the past few years. Not as bad as they were 15 years ago, but you can see right now the home builders sentiment index is around 40, consumers are around 60. We'd like to see those come back up. It's more of the apartment inventory here in Philly and new home building in the suburbs gets absorbed, this will come back up. But until interest rates come down and inventories come back up, we won't see either of these lines come back up. So again, housing right now, basically in a soft spot, not only looking at the underlying economic data, but just looking at the moods of home buyers, home sellers, and home builders. And I assure you the realtors are no different. Supply side, construction costs. So, what does it cost to build a home in Philadelphia and elsewhere? Well, first of all, we're going to break that into wages versus materials, okay? In construction, you probably learned about hard costs and soft costs, right? Hard costs are your materials plus your labor. Soft costs is like all your overhead, okay? So let's look at wages first. The orange line is construction wages in the U.S. This is published by the U.S. Bureau of Labor Statistics. For comparison, I've got the gray line is the inflation. It's the consumer price index. The percent change in that gray line is the official U.S. inflation rate. Notice that, generally speaking, over time, the orange line and the gray line track each other pretty closely, right? So generally speaking, wages in the home building industry and construction in general rise at roughly the same rate as inflation, which is good because it means it's stable. So the cost of labor, if you're a builder or developer here in Philadelphia or elsewhere, generally speaking, is a pretty stable number that tracks inflation. That used to be true of materials. So this is lumber and sheetrock, steel, wiring, tile, fixtures, cabinets, everything else, everything in a home that you touch, right? That used to track inflation up until what happened in 2020. Yeah. Remember the pictures of all those cargo boats sitting off Long Beach? They were all in a holding pattern, California. What do you think was on those boats? Chinese steel, Canadian lumber, Italian tile, gypsum from Mexico, that's the main ingredient in sheetrock, wiring from Central America and South America, gypsum, main ingredient in sheetrock, copper, the main ingredient in wiring, also from Central and South America. And the supply chain choke points really whacked us during COVID, and as a result, materials costs went up by 50%, okay? Then on top of that, we had an election in 2024, and the guy who won declared that tariffs would be really good policy. So on top of that, we're getting another 25%. Now, I can't just add 25% to that chart because the way the tariffs are set up, there's all sorts of trap doors and back doors, and sometimes it's 15%, and sometimes it's 20%. So, but it's not helping, okay? This is the other pain point that the builders are facing right now if you talk to them. Realtors complain about interest rates and low inventories. Builders complain about interest rates and high materials costs. Because when basically to build a home or even just to rehab a home, your materials costs are roughly about 40% of your total budget on average, okay? So if I run your budget up by 25%, I'm sorry, 50%, and that's 40% of your costs, just imagine if your household budget, your monthly expenditures suddenly went up by 50%, but your income stayed the same. You'd be feeling that, right? That's exactly the position the home builders are in right now. They're feeling it, which is why no one's lending them money right now. It's not just because interest rates are high. It's because profit margins are so compressed, due in large part to materials costs being so high right now. So it's kind of ironic, I think, that Mr. Trump is still so supportive of these tariffs because he's a real estate developer, at least he was. And I know he understands this, but I would think he'd be more sensitive to this fact, but he's not. So, but this is an economics seminar, not a political science one, so I'm not getting into it. Okay. Well, I know a lot of builders, and they know him. Believe me, he understands it. He just doesn't care. So the other factor on the supply side, besides materials and wages, is land. Right now, here in Philadelphia, we're largely a built-out city, so there's not a whole lot of large parcels of vacant land. In home building, there's what we call big economies of scale. The more units you build in one place, the lower per cost per unit gets. Okay. So in other words, it's much cheaper to build 50 homes in one building, 50 units in one building, than it is to build 50 single-family homes scattered all over the city, right? Because just think about it, you got to drive your crews all over and materials and all that, right? So land is very, very important. They often say in real estate development, you don't make your money when you sell, you make it when you buy, particularly when you buy the land. If you pay too much for your land, that's very, very difficult to get out from under because there's very little you can do to influence rents and prices. So once you've committed your money to the land, the only thing you control after that is your construction budget because you have very little influence over what you can sell or rent it for. That's set by the market. Now granted, how upscale or downscale you want to go will put you into a certain segment of the market, but ultimately you do, believe it or not, do not determine the rents or the prices. And most real estate professionals recognize this. But so when you go into the land and you overpay, you can end up underwater very fast. And a lot of new developers and investors make that mistake. But as you can see, this shows the average price of an acre of land in Pennsylvania broken out by urban versus suburban versus rural. And as you can see, there's a very, very huge, large urban-rural differential in land prices in Pennsylvania. An acre of urban land in Pennsylvania, like here in Philly, goes for just over $30,000, okay? By the way, an acre typically will hold about 4 Philadelphia row homes. So a quarter an acre is like the size for a high-density urban development, okay? So that's 4 homes you can put on 1 acre. So if you got $30,000 in change, you can buy an acre in Philadelphia, you can put 4 row homes on it, okay? If you go to the suburbs, you're down to about $18,000. And then in the rural areas, like in the middle of the state, places we never go, you can get an acre of land for just over $5,000, okay? So big differential in land prices based upon location here in Pennsylvania. All right, so that's the market, all right? Now the macro stuff. Now we're going to dump into the micro stuff, the actual stuff specific to the housing market. Are there any questions so far? Yes, ma'am.
Yes, you spoke about the companies and you talked about the job growth. Is it because more people are looking for those, I don't know, top 10 companies?
Well, they're the top 10 biggest employers, and I'm measuring big by number of employees, not assets or revenues or something. So yes, they employ the most people of anyone else in our region. Those are our top 10 biggest employers. But on top of that, there are also what I call our export industries. They make things that people in other parts of the country buy from us. So they keep our region afloat, right? Comcast, perfect example. Or American Airlines, right? American Airlines, you're flying from one place to another. Comcast, almost anywhere in America, you can subscribe to Comcast. So even though their jobs may be located here, they pull in money from other parts of the country to bring here. That's why they're so key to our economy. It's not just the number of people they employ.
So the job growth is not correlated with those companies?
The overall job growth?
Yeah, you had a slide with job growth.
That was total job growth. It is correlated, but those companies account for maybe 10 to 15% of all employment. But again, it's the cream. It's the 10 to 15% highest paying jobs in our region. Okay.
Surprising to see giant supermarkets now. They're popping up all over the place as
They've actually gone kind of upscale. I mean, in the last few years, they really remodeled, and I mean, we go to the one in Jenkintown all the time. It's pretty nice, and it's not Whole Foods prices either. So, yes, sir.
To summarize why the builders are waiting, the interest rates are part of it, the housing market in general, and the cost of materials.
So there's oversupply, and that's typical. We built a lot of new apartments, but that's typical in real estate. Real estate's cyclical. You overbuild, and then you got to absorb it, and then you go into a hot spot, where demand exceeds supply, so prices and rents start going up. Then you start building again, then you overbuild, you got to absorb it. That's how it goes. So when I say we're in a soft spot, I don't mean that's something to freak out about. I'm saying that's typical. It's a cyclical industry. It's a cliche. Yes, ma'am.
So, do you think in this market, from a development standpoint, it is safer to do adaptive reuse as opposed to ground up?
For right now, yes. In Philadelphia, the city, yes. You're much more viable to rehab a row home, and then if you're going to build a brand new single-family home, that is very expensive. You're not going to get any economies of scale building one house. You're going to be and unless it's a custom build where you've got a wealthy client that's commissioned it. So in other words, you're going to build on spec. You don't know who you're selling it or renting it to. You're just going to do it and then advertise it. That's also going to increase your risk. So yeah, rehabbing right now is a better play than new construction if you're doing small scale stuff. Now, if you can get 5 acres of land and do 20 houses or an apartment building, that's a different story. You get some other questions? Yes, sir.
Why are the headquarters in other places instead of Philly?
Oh, a much more attractive business environment. I mean, businesses are leaving California and Illinois right now like crazy. I mean, California is enacting a wealth tax, which might sound good, but here's the problem with it. It's a tax on unrealized wealth. It'd be like if the government, Uncle Sam, taxed you on the raise you haven't gotten yet, but you got to pay that tax today on the raise. I would imagine you wouldn't care for that. Well, California's got a lot of billionaires, and you might think, well, yeah, that's who we should tax. I mean, hey, I know plenty of 20-somethings that think Mamdani is the future, okay? But the problem is capital is very, very mobile, especially between states. Not as quite as much between countries. By that I mean, you'll change states before you'll change countries. Most people will anyway, right? But you'll change states pretty easily, or cities, right? So they're leaving California, they're leaving Illinois, they're leaving Massachusetts. The winners, Arizona, Texas, and Florida, the big three. Mass, New York, Illinois, California are sort of the big four losers right now. We're kind of in the middle. We're treading water. Yes, ma'am?
Not to get too deep on that, but don't they meaning the billionaires, they get to borrow money off of that income, right?
Well, yeah, technically, but it's still not realized. But they have to pay the taxes today. If they're borrowing that money, normally what the fair way to do would be they have to pay the billionaire tax when they realize that gain. So in other words, if they borrow that money, then they make money off it, then you would pay the tax. What they're saying is they've got to pay that tax today on money they won't get till tomorrow. And by the way, it's not guaranteed they're going to get that money tomorrow, right? If you borrow money to start a business, it's not guaranteed the business is going to pop. It may not. But fair or not, whatever you might think of the tax, they're losing their tax base, okay? And that's not good. Because, like I said, when you lose that cream of your tax base, you're left with middle class and low income people. And it's like, the economics of running a city really aren't that different from running your household. In that, basically, I don't want to be too old fashioned about it, but someone's got to be daddy. Someone's got to be the breadwinner. You cannot run a household if it's all dependents, right? Somebody's got to earn more than the people that take money from you, who usually we call kids. And sometimes your freeloading brother-in-law, right? So you cannot run a household on just kids and a freeloading brother-in-law. You'll go bankrupt. Same is true of states and cities. That's all you need to know about public finance. All right, thank you. Have a good night. All right. Yes, sir.
So the 1% that left, the billionaires that lived in Center City, they moved to these other cities because of why? Because Washington's market is, well, I understand, is very different than ours. So why did they move?
COVID. Right? Turns out old people don't like living in high rises with lots of other people. When there's a pandemic, you got to share the elevator, share the hallways, same circulated air, right? On top of that, this gets downplayed a lot. The media doesn't talk as much about it. I will touch on it, but it's a sensitive topic is the George Floyd riots. Old people don't like public unrest. Now, they never said that, the PD won't quote this, but I do this all the time. And privately, people have said this to me. When people are throwing, stones through the windows of shops on Walnut Street and doing smash and grabs, and the theaters are closed and the restaurants are closed, and you're afraid to step out of your house because you're 75 years old, old people don't like social unrest. So on top of that, plus risk to their health, they decided, they were going to go to their home at the shore or the condo in Florida or Arizona. They thought they were going to ride this out and then come back, but they're not. They're retired. They're gone. I mean, you're 85. Once you've moved, you're not moving again.
So these are retired.
Yeah, that's who we lost. Some went to the main line.
So went to the suburbs then? Those
Yes.
people went to the suburbs.
Yeah, you saw the population. The suburbs actually gained population during COVID.
From those people,
From some of them, yes. Some went to the burbs. But like I said, a lot of them went to what they were eventually going to retire to, the shore home, condo, Sunbelt. Yeah. We had some other questions, sir?
So, to my knowledge, a lot of the financial institutions that were in Philadelphia have kind of fled to Wayne, Malvern, Conshohocken because they're a better environment. Do you see the office conversions that are happening in Center City as a net positive or like a net negative because we're not really allowing those companies to come back?
Well, now it will be a positive because that space is just dead. But it was negative that we lost it in the first place. So first, we should talk about why we lost it. It wasn't just COVID. So I talked about high taxes and regulations. Philadelphia's business environment is not the most attractive. I do this around the country. People bitch and moan about Philly who are not from here like you wouldn't believe. They've come here to try to do things, they get jerked around, they leave, okay? One thing that I can tell you about Philadelphia isn't just that we tax too much, we tax the wrong things, okay? We have the highest local tax burden, second highest local tax burden of any city in the country. By that, I mean the percent of your money that you pay in taxes to Philadelphia is second highest of any city in the country. You want to know who number one is? Probably can't guess it. You would think, no. That's what I would have guessed. Bridgeport, Connecticut. Now, that doesn't mean we pay more taxes than New Yorkers. It means we pay a higher percent of our income in city taxes than New York's pay as a percent of their income in city taxes. They may pay more dollars, but they make more dollars. But we pay a bigger percent to the city. Now, they also pay more in state and federal, but I'm not going to get it. We're in Philly. We're going to focus, because that's really where our bite is. That's bad enough. But we also tax the wrong things. Philly has lots of taxes. We have a wage tax. We've got several business taxes. We have a sales tax. We've got a liquor by the drink tax. We've got a hotel by the night tax. We've got restaurant taxes. We've got parking taxes, okay? Tourist tax. If it moves, we will tax it, okay? Now, here's the problem, besides taxes being too high. Almost half of Philadelphia's revenues are reliant upon the wage tax, okay? Only about 25% of revenues are reliant on the property tax. Most cities and municipalities are financed by a property tax. You want to know why? Anyone want to guess why? It's stable. So in economics, we say there's four things you can tax if you're the government, okay? You can tax people, you can tax businesses, you can tax transactions, sales, or you can tax property, all right? Of those four things, which is the least mobile and least able to escape a tax? Right, you can't jack up your home or your land and move it, right? You can change jobs, go get a job elsewhere. You can change, your business can change locations, relocate somewhere. They're doing that from California to Texas right now. Sales, oh, we would never go to Delaware and buy a big ticket item now, would we? No, not us, no. But other people do. But property you can't, right? So that is actually very good for budgeting reasons. First of all, not only it's a good source of revenue in that it's difficult to escape, but it's like you said, it's a stable source of revenue because wages and business revenues and sales go like this over time with the economy. Property does not go like this, right? You don't wake up one morning and find out that the housing market has crashed like the stock market could have overnight, right? It doesn't do that. So it's just like running your budget. Remember I said running a city is like running a household? You have a budget for your household. You know what your expenses are every month. You've got rent or mortgage, utilities, clothing, food, incidentals, and some other stuff, right? So same thing with the city. But with your budget, you know how to budget because you know what your income stream is. I'm guessing most of you have a job, right? And you know what your paycheck is going to be and when to expect it. Imagine if you don't have that when you're running your household. Suppose every week you flip a coin, and if it ends up heads, you go to work that week, and if it's tails, you're fired. And then next week you flip the coin again. And if you do go to work, once you get there, you flip a coin, and either that day you'll make minimum wage or you'll make $50 an hour. And remember, every week is like that for you. Can you manage your house like that? No, you'd be living week to week, right? You can't plan, you can't budget. Same thing with cities. Philadelphia has that problem. So they not only drive people out and businesses out and transactions out, the quality of our public services is very volatile and unsteady because the revenue stream that supports it is unsteady. By the way, going back to your question about businesses, the reason I came to Philly is to go to Wharton, so I know a lot of other alums. And we lose a lot of startups here in Philadelphia because, again, it's not just that we tax too much, we tax the wrong things. I mentioned we tax businesses as well. Again, we tax the wrong things. Taxing businesses is bad because businesses are mobile. But we tax revenue as opposed to profits. Why is that bad? Because it's a huge deterrent for startup businesses to start here for the very simple reason that most startup businesses lose money their first few years. Well, if you're losing money, but you're in Philly, you chose to start in Philly, you still have to pay the city taxes. So why would you do that? Start in the suburbs, then if you, for some reason, you need to be in Philly later, then you can open up a branch here, right? An anecdote to support this. One of the alums I went to Wharton with, she's middle-aged now like I am, worked in investment banking here in Philly, did very well, makes 6 figures, decided she wants to start her own firm, right? So she's wanted to start 20 people, start her own wealth management fund. 20 people, she now employs. She wanted to be in the city because that's the youthful talent. And young people, generally speaking, want to be in the city. But this was just too much of a bite for her. So she started out in Bryn Mawr. That's 20 high-paying 6-figure jobs that we could have in Philadelphia that we don't. All right? You take that simple example, multiply times a million other decisions. I mean, how many people graduate from our business schools that could stay here and start? They don't. We have one of the lowest retention rates of any major U.S. city. Most of the students that stay in Philadelphia after graduating were from here to begin with. Okay? I guarantee you plenty of business school students that graduate from Columbia or Stanford stay in New York or San Francisco. In Philly, you graduate from Wharton, you're on that Amtrak to New York like the second you've got that sheepskin in your hand. So, another one of our challenges. All right, let's dive into the housing market specifically, okay? So we'll start with sales, home sales. So this chart here shows the number of home sales just in Philadelphia County going back to 1980. And you can clearly see that home sales are very cyclical, just like the industry. So the red line represents the quarterly average. In any given quarter, about 3,500 houses change hands in Philadelphia. And these are just houses. So I'm not including condos or apartments or anything like that, just single-family houses, okay? So here you see the boom of the 80s. Here's the recession of the early 90s. Here's the housing bubble years. Back in 2005, we had 7,000 homes, more than double our typical average, changing hands every quarter. Great recession. Here's the recovery. Here's COVID when interest rates were really, really low. And then here's where we are today. So you see we're down from our COVID peak. We know interest rates are up. That's part of the reason. We also know that inventories, the number of homes listed for sale, is down, very low right now. That's why sales have dropped. But again, here in Philly, we're doing pretty well compared to the other large metro areas. Our sales are still running slightly above average here in the city, even though they're down from a few years ago. Okay. By the way, why is that? So sales have dropped. So 2 reasons. There's one is why first-time home buyers are sitting on their hands and why move-up buyers are staying on their hands. For first-time home buyers right now, affordability is the big one. You keep hearing the A word over and over. Right now, the millennials and the Zoomers are in better shape than they were 5 years ago during COVID. They've been working from home. They haven't been going out as much. They've been paying down their student loans. They've been saving up to build up a down payment. They've been improving their credit scores. They're a little older, so they've probably maybe gotten a raise or 2 or 3 at work, right? So they're in a better position right now. But for those young first-time buyers, prices are just still out of reach for them, at least given the down payment constraint. The number one thing that first-time buyers faces a hurdle right now is that down payment. Realtors are telling me that right now, in their entire career, they're seeing more parents show up at closing with their checkbook to help their kids out with the down payment than they've ever seen before. What the parents are doing now is, rather than waiting for their kids to make their inheritance in the estate someday, they're helping them with the down payment now with their inheritance. And they're telling them, by the way, I see there's more than 1 bedroom in this house, so how about you and Honey Bunny get busy with making some grandkids for me and Mom here. You can't complain you don't have a house. Here's the check, okay? There you go. So that affordability is what's keeping a lot of young buyers out of the market right now if you don't have wealthy parents. For the move-up buyers, mostly you guys I would think, the lock-in effect of higher rates is the problem. So by that, for people who bought, say, 10 years ago when interest rates were really low, you're now asking them to move into, even if they want to move into a new home, they're being asked to do it at a higher rate and hence a higher payment than they would otherwise at a time when supply is really, really low. So they're probably not going to get the house of their choice. So let me ask you a question. You drive a Mercedes. I'm going to trade you into a Honda that's going to have a higher payment. You want that deal?
Not at all.
That's what move-up buyers are being asked to do right now. I'm going to give you a smaller house at a higher price. No. So they're sitting on their hands too. That's why the sales are down. Okay. Now you still have people moving just because people change jobs and get divorced and all sorts of other things, right? But as far as the economy goes, the things intrinsic to the housing market, those are the two big obstacles, the headwinds on home buying right now. Apartments, here's apartment transactions in the Philadelphia area. This is measured in terms of millions of dollars, not number of units. Notice the surge in apartment sales during COVID in 2021, 2022. Since then, they've dropped. Again, prices went up, rents went up during COVID. Then we broke ground, built a lot of new apartments. That's being absorbed. So as a consequence, apartment transactions right now are down because right now the developers are not building apartments and then selling them. They're building them and then leasing them. Then they'll sell them. All right, that's sales. Let's talk about house prices, the big one. So this is my house price index for Philadelphia County. Think of it as a Dow Jones index for the value of a typical home in Philly. The actual level of the index doesn't mean anything. Its percent change over time, though, reflects the average percent change in the value of a typical Philadelphia home. So the index has a starting value of 100 in the year 1980, okay? Currently, we're at a value of nearly 800. Meaning the typical Philadelphia home has grown 7 times in value since 1980, septupled, if that's a word. How do I get this? I take all arm's length home sales in Philadelphia every quarter, and I clean them to drop out sheriff sales and foreclosures and interfamily transfers and all that stuff. So I just have clean market prices, arm's length sales. And then I run what's called a regression. So it filters out all the seasonal noise and idiosyncratic noise. So, if in 1 month only homes in Chestnut Hill sell, and then the next month only homes in Eastwick and Southwest Philly sell, well, the average price would go down. But that doesn't mean house values went down, right? It just means it depends on which homes sold during that period. So I make all sorts of statistical adjustments so that the index, rather than just looking at the average price of a home in Philly, removes all that noise from the data. So we just have something that's driven by pure market trends. So this is the change in house prices driven just by the housing market itself. It has nothing to do with seasonality or whether, your wife just loves that kitchen. That's why you paid so much for that house or something like that, right? So again, you can see here's the boom of the 80s, recession of the early 90s, which was a fairly mild one, recovery of the mid-late 90s, housing bubble, Great Recession, peak to trough, house prices in Philly fell about 23% over 4 years. We hit bottom in 2012, enormous recovery. There's the dip during COVID, right? And house prices have risen 33% in Philadelphia since COVID. So when you hear everyone talking about the affordability problem, that's what they're talking about, right? So just to put that in context, so in 5 years, house prices in Philly have risen 33%. Has anyone here had their income rise 33% in the last 5 years? Wish, don't we, right? Yeah. That's how affordability problems happen. By definition, it's when the price of something rises faster than incomes can keep up, right? So no doubt about it, prices have risen faster than incomes since COVID. To put that in context, the typical Philadelphia home returns an average appreciation rate of 4.5%. Meaning if you just threw a dart at a map of Philly and bought that home with cash and sat on it for a year, chances are after 1 year it would be worth 4.5% more than what you paid cash for. Okay, that's the average, historical average. Typical T-bill returns about 1 to 2% per year. Typical corporate bond, about 2 to 3% per year. The stock market returns about 7 to 8% per year. So the typical Philadelphia home, in terms of its risk-return profile, is between a corporate bond and a stock. Okay? So it's right in between, which makes it a pretty good investment because it's also a good hedge. When stocks and bonds are doing one thing or another, housing is doing the opposite. So basically one of your assets will always be going up, or at least your portfolio's value isn't going down as much as just one asset will, right? So it's a good diversification as well. But that's what the typical risk-return profile is for Philadelphia homes. But as we've seen, house prices have risen dramatically since COVID. We know why. First of all, low interest rates, right? We saw how low interest rates went when right when COVID hit because we had a recession. That's the price of credit. We had low inventories, supply. So when supply shrinks, what happens to the price of something, right? And then we had the shift to working from the office to working from home. That increased the demand for homes, right? As one, I like to say, during COVID, your home not just became where you live, it also became where you work. Well, you know what? Remember when everything was closed, you couldn't go out and spend money? Well, people started spending money on their homes. Your home wasn't just your residence, it wasn't just your office, it was your gym, it was your theater, it was your restaurant, it was your spa. It was all these things. All the money that people would spend outside of their home, they started spending on improving their homes. And that gave another boost to house prices, right? Suppose no homes in Philadelphia sell for the next 6 months, but everyone improves their home. Well, the average value of homes will go up, even though no one's building new homes or the prices haven't gone up just by the improvement. So that's another factor that's driving that red line up, okay? So that's why we've seen that 33% growth. Those are the big three reasons since COVID, all right? Those are petering out right now. We know that prices are leveling off. In fact, you can see it. If you look at the red line, see how it's starting to sort of level off up there? So how does Philadelphia compare to the country and to our suburbs? So the red line is the index for Philadelphia, the green line is the suburban price index, and the blue line is the national house price index. So we can compare Philadelphia to our suburbs and to how the rest of the country is doing. Philadelphia is a city, notice it tends to outperform the country. When the country's up, we're really up. When the country's down, we're more than down, vice versa. Again, here's the upswing. Notice we rose by more during the bubble. We collapsed by a little bit more. We rose by more than the rest of the country. I mentioned we're counter-cyclical. This is not the house price index for other large U.S. cities. It's the house price index for the entire country. So it's including a lot of rural and suburban areas, okay? But look, our suburbs outperform us, though. Probably no surprise to you, right? So notice that during the recession of the 90s, the suburbs leveled off, but they didn't fall. Same thing during the Great Recession. We fell about 23% peak to trough. Suburbs fell by about 12%, about half what we did, okay? Because their fundamentals are better. They rose by more than we did, and right now they're starting to level off, too. Okay. So further evidence that the market is entering sort of a cooling cycle. Moreover, like I said, the reason the house prices, notice that especially, look at during COVID. So here's COVID 2020 right here. We took a dip. See how the suburbs went up? And see how they went up by way more than we did? We went up by 33%. We think that's a lot, don't we? They went up by like 55%. Again, people leaving the red line, moving to the green line, city to suburbs. And it's the wealthy people moving. That's why the prices are up so much in the burbs. Okay? Just go to the main line. All right. Let's look at rents. This is the median rent by county for every county in the metro area. So again, the red line is Philadelphia County. The green lines are the South Jersey County. Blue is southeastern PA. And then the purple one is Newcastle County in Delaware. The vertical dashed line is COVID. And then the black dashed line is the consumer price index, inflation. There's a big variation in rents across the region, but you can see they all sort of moved together over time, right? See how they sort of went down during the Great Recession, then they recovered. And by the way, historically speaking, rents are kind of boring to watch, right up until COVID. See how rents generally tracked inflation? The highest rent county up here is Mercer. That's where Princeton is. Right now, to rent a house in Princeton is about $2,600 a month. Philadelphia, to rent a house is about $1,200 a month. It's quite a spread. Okay, Princeton's more than double what it is in Philly. We're the poorest, lowest rent. Princeton has the highest. But notice that rents generally tracked inflation. They didn't grow by as much and weren't as volatile as house prices up until COVID. But then everyone started working from home. Interest rates dropped. We started adding a lot of new luxury apartment product. Apartment rents really, really went up across the region, especially in the suburbs, because it started building a lot of new apartment product out there. Have you been out to King of Prussia lately? Have you seen the apartments that they're building out there? These are apartments for the people that would normally be first-time home buyers. But these are, upper 20-somethings and 30-somethings, and they can't afford to buy. So they're a little too old to be living with their parents. And what's more, they're starting to couple up and have kids, so that also inhibits you. So what are they doing? They're renting. So what developers did during this cycle, they're aware of this, is they started, rather than building one-bedroom apartments, which is sort of traditional for apartments, they're building 2, 3, 4-bedroom apartments to raise families. What's more, they're adding a lot of amenities to apartment buildings that were not part of traditional apartments. So, you go out to King of Prussia, they're apartments, but they're offering suburban living for what otherwise would be young home buyers. So, they're not just apartment buildings, they're communities. You've got fire pits and you've got dog parks and you've got common areas with kitchens to socialize and meet your neighbors. These are 2, 3, 4-bedroom apartments, so you can raise kids, you can have a home office as well. They're offering a whole, basically, something that's very new in U.S. history, which is a long-term renter life cycle. Historically speaking in the U.S., if you were a long-term renter, it's primarily because you couldn't afford to buy. But even working class people in the U.S., could afford to buy up until very recently. So the development communities responded to this by basically building full-time, long-term renter communities that'll be much more family and couple-oriented than they used to be in the past. Now, whether or not we can solve this affordability crisis and start to bring our home ownership rate back up again, which I think would be good, remains to be seen. But that's the situation that the market is at right now, and that's why you came here tonight. All right. So moving on, some other market metrics. Here's the top apartment sales in the region, top 10 sales of apartments. The average price of an apartment unit right now in our region is about $280,000. So, if you've got a 25 unit or 50 unit apartment building, you sell the entire building, that would be the typical price you could expect per unit. So just multiply that 280 times the number of units in your building. Now that's for a middle class, class B apartment that was built 30 years ago. The class A ones, brand new ones today, you're probably looking at $500,000 a unit, okay? I took my students on a tour of one project in Fishtown that is targeted to people exactly like them, young Zoomers, college educated. And the amenities these places have, you wouldn't believe. The rooftop deck, they actually modeled like a cabana in Southern California. I mean, there's jacuzzis and tented cabanas and outdoor ovens, grills, kitchen areas, wet bars. Inside, there's a spa, not just a gym, a workout center, a spa, sauna, steam room. There's even an oxygen bath chair, like recliner you get in, you seal yourself. I mean, these are for 28-year-olds, They're worrying about aging, I guess. But, I mean, that's why they're $500K a unit, because they're amenitized 8 ways from Sunday. They're selling a lifestyle now, not just a place to live. Yes, sir? They are. The rental market was softer last year. It's still in a soft spot, but the occupancy rates are coming up. There's probably another year to 2 left before we get. And apartments. Condos people own, apartments people rent. These are apartments. An average price of an apartment is about $280,000. Meaning, if you own an apartment building that's being rented out, but you sell that building to another landlord, that's how much he would pay per unit. Yes.
Well, who are they building for if the job market, you said, is not the top 10 corporate trading companies? Because the 28-year-olds that are in the university or ed or hospitality, are they making that type of salary to afford that type of apartment that you're speaking of?
Yes.
To me, I don't think they are.
If you're a 24-year-old working at Comcast, you can afford a $2,500 rent, apartment.
So those apartments you just mentioned are going for like $2,500.
Oh yeah, and they're going.
So still affordable.
The ones that are struggling are the Class C ones that have no amenities, that were built in the 1950s and are depreciated and don't offer any type of real lifestyle.
Okay. All right, I'm following.
Yeah. And by the way, if you're wondering why are we building apartments if our population is not growing, it's redevelopment. 28-year-old college-educated office employees don't want to live in a row home that was built in 1925 in Kensington. They want to live in an apartment in a community. So they're tearing down the old row homes and redeveloping them into apartments. Fishtown, poster child.
I was thinking more about the industries that you mentioned between eds, beds, and hospitality. Are their salaries in the higher brackets going to 6 figures where that affordability matches? Like the people in the city, like school district, I'm thinking those aren't those type of, outside of Comcast, right, because that's tech, that their wage is that high that can meet that affordability.
Yeah, it's not nurses and receptionists going into these new apartments. Right. Correct. Yeah. But we still have a large college-educated population here that is moving into those new apartments. By the way, I'm going to show you building permits. The amount of apartments we've added may be significant to us, but as a percent of our population, it's in the single digits. In other words, we've only grown our housing stock by like 4%. Okay, so it's visually huge, and it's probably more development than we've seen in our lifetimes. But believe me, when I travel quite a bit, one of my favorite things to do when I go to another city, when I take the drive in from the airport, is I like to count the amount of construction cranes. You go to the Sun Belt, you go to Tampa or Tucson or, Dallas. They've got like 40 construction cranes on their skylines. And by the way, Tampa and Tucson are smaller than Philadelphia. We get 10 cranes on our skylines. We think it's like, party time. And it's a very, very modest accomplishment by our own standard, but compared to other city standards. Yes, sir?
So I noticed that Philadelphia Housing Authority is the buyer for 5 of these properties, and I recognize several of these. They've been known to buy things at kind of like a skewed number. So is that average price per unit skewed due to that?
I'm showing the top 10, but that average is probably across about 50 sales. But yeah, PHA also, by the way, is, believe it or not, the single biggest landlord in all of Philadelphia. In terms of the number of units, they manage more units than anyone else. So people rail about evil landlords. It's like, for a city council member to complain about that, it's like one city employee complaining about another city employee. That's our city. All right, moving along. How are we on time?
We're good. Maybe can you wrap up 5-10 minutes?
Yeah, I'll skip the housing bubble part. So let's look at where the action is. So this is where are the home sales activity and what are the prices. So this is a map showing every arm's length home sale in Philadelphia in the last quarter, okay, in Q4, because we're still in Q1 of this year. What I do is I color code them by price per square foot. So you remember your stats class from college? Remember your bell curve, right? So I take all sales in Philly in the last 3 months, and I compute the price per square foot. I then look at that distribution, and it follows a bell shape. I then carve that distribution up into fifths. So 20% of all sales fall into each of those 5 categories. And then I apply what's called a temperature color ramp to that. So the cool colors denote relatively low price sales, and the hot colors denote relatively high price sales. So the bottom 20% of all home sales in Philly, the dark blue dots, occurred at a price point of $90 a foot or less, right? And then, as you can see, is the low income parts of the city: North Philly, Lower Northeast, West Philly, Southwest Philly. The next 20% of sales, the light blue dots, took place at a price point of $90 to $160 a foot. So again, those are sort of the working class areas of the city. Again, Lower Northeast, Upper North Philly, sort of transitional neighborhoods, between poor and rich areas, so on and so forth, until you get to the top 20% of all home sales in the city, which are the red dots. Those are at a price point of $280 a foot or more, okay? You can see where they are. Center City, Fishtown, Kensington Art Museum, South Philly, Manayunk, Chestnut Hill, Mount Airy, University City, right? Now, 20% of all homes in Philly sell at a price of $280 a foot or more, meaning 80% of Philadelphia's homes have a value of $280 a foot or less. Who here is planning on becoming a developer? Who can build me a new home for $280 a foot here in Philly? Can you? Maybe a log cabin, okay? Think about that. We've had enormous price appreciation over the last 5 years, in fact, over the last 10 years, faster than incomes. Yet our construction costs in Philadelphia are still so high that even with that price growth, most of our housing stock is still underwater. Meaning that, say we were to suffer some terrible natural disaster event, like the waters of the Schuylkill and the Delaware rose and wiped out the city, and Philly got a do-over, and you just left it to the market. In other words, no state, federal aid of any type, okay? No charity, just the market, okay? That means only about 20% of our housing stock would be replaced. Think about that. And by the way, it's the top 20% of our housing stock. So Center City would be rebuilt, Northwest Philly would be rebuilt, University City would be rebuilt, the rest of Philadelphia would revert to farmland. Okay? That's how high our cost of development is, all right? The reason, as I like to say, we have several sayings about Philly. We not only tax too much, we tax the wrong things. In real estate in Philadelphia, we have Baltimore rents and prices, but we have New York construction costs. Why? Taxes and regulations are a big one. First of all, one of the biggest ones is councilmanic prerogative. You heard about this, councilmanic privilege? All right. I cannot tell you how many developers and lenders and investors from out of Philadelphia have learned that phrase and said they never want to hear it again. They never want to come back. Because the development process here in Philly is so politicized that it adds to the uncertainty of development. And in development, time is literally money, because everything is done, all real estate development, all serious real estate development is done with borrowed money. It's like not paying your credit card every month. The longer it takes to get that building permit or that zoning variance before you even break ground, you're paying interest every single day, okay? And you got to attend the PAC fundraisers to, kiss some council members' butt, shell out even more money from your checkbook just to keep the process going until you finally, eventually, hopefully get your zoning variance or your permit. That's a big one right there. Then we've got these things called unions. And as much as we may love unions, they have great training programs, and they also have good safety records compared to non-unions. And you also stay away from the whole volatile subject of immigration if you go with union, because most of them are not illegal immigrants, okay? But they're very, very expensive, okay? We are second only to New York in terms of our construction costs. Just to give you an example, let's say we're going to hook up a washer and dryer in a rehabbed home or a brand new apartment building in Philly, okay? In the suburbs, or in pretty much anywhere else in the country, you'd have a contractor and he would have an apprentice. They'd wheel in the washing machine and dryer. They'd connect the water supply line, connect the air duct, the vent, plug it in, snug it up against the wall, take us an hour and you're done. And you'd probably pay them $35 an hour for an hour to two worth of work. In Philadelphia, You have to pay 2 general laborers $35 an hour to wheel the washer and dryer in. Then you have to pay a plumber $55 an hour to connect the water supply line and the drainage line. Then you have to pay an air duct worker $65 an hour to connect the vent. Then you have to pay the 2 laborers to come back to snuggle the washer and dryer up against the wall. And then for the cherry on top, you have to pay an electrician, and by the way, it has to be a master electrician, not an apprentice or journeyman, a master electrician, $75 an hour to come in and plug both of them in. And if you think you're just going to hire a laborer to do this, or you're going to do it yourself, there's another guy on that job site, okay? He's called the shop steward. And a shop steward, in case you don't know what that is the opposite of your friend as a developer, okay? He's a cross between the class clown, the class bully, and the class hall monitor. And he's there to make sure you don't even think about violating any of those work rules. If you do any work yourself, or you have an electrician do something that a carpenter's supposed to do, or a laborer's supposed to do, that a skilled trades person's supposed to do, he will slap a grievance on you on the spot, shut down all work on the site, everyone out of solidarity will quit working, and now you're paying interest on a building that's just sitting there and not work is getting done. So you know what? You're just going to pay that extortionate, if you will, tax to get your washer and dryer hooked up, because that's still cheaper than having work shut down on your project for several weeks. Well, and believe me, they'll do it just to punish you and make an example of you, okay?
That's the large projects, not the small projects.
Yeah, I mean, small ones, correct. I mean, if you're just rehabbing a row home, you're not using union labor. But you can't do, real estate development, like I said, has huge scale economies in it, and any development project of any scale of more than a few units in Philly is pretty much union, and it gets expensive fast, okay? So prices are up, but not enough even to cover our high cost of construction, is my point here. So let's look at where the money is. So let's see where the $1 million sales are, right? So these are all $1 million sales in Philadelphia in the last 3 months. So every dot is a home that's sold for $1 million or more, which is considered the threshold for luxury. This should say Q4, I'm sorry. The realtors like to look at these charts, maps, because they want to see where the money's landing, right? As you can see, Center City, the neighborhoods that touch it, Northwest Philly. Almost next to nothing in the rest of the city. If you look at the suburbs, see a different story. Particularly in the luxury segment since COVID. So this is all $1 million sales in our region in the second quarter of 2020, peak quarantine. Here they are in 2025 Q2, okay? There's about twice as many red dots now than there were 5 years ago. Now, have we produced twice as many millionaires in the last 5 years? No. We've had some New Yorkers move here. That's about it. That's not enough to explain it. It's because, again, the shift to working from home, particularly for high-income households that have done very well during COVID, as opposed to working-class households that can't work from home, they're the ones driving up the luxury segment. It's not that we are building some $1 million custom homes. It's that what used to be an $800,000 home prior to COVID is now a $1.2 million home today, all right? And by the way, we think that the Center City is pricey. For every $1 million home in Center City, you've got 7 or 8 on the main line. But even then, the main line may have the most $1 million homes in our region, but the most expensive housing in our region is actually Princeton up there. What is a $1 or $2 million home on the main line is like a $3 or $4 million home in Princeton. But not only is it Princeton, but then you're sort of into New York's orbit once you're up there. In fact, if you look closely, that's Staten Island right there. And Amtrak runs right through there. So, I mean, if you live in Princeton, you know, you can feasibly commute to New York every day. It's only about 40 minutes. Not cheap commute, but you can do it. So anyway, that's where our $1 million luxury sales are coming from. This is the number of $1 million sales in our region, going back to 2005. In any given quarter, we'd have about 300 luxury home sales in the Philly metro area. 2020, COVID hit. Luxury sales in our area have tripled since COVID. So house prices are up, but the luxury segment is really up. And again, it's not because we're building a lot more luxury homes. It's because, well, basically, it's gentrification, but it's middle class gentrification. These homes are moving from upper middle class to upper class status, and particularly in the high income neighborhoods of Philly, like Chestnut Hill, Mount Airy, and then of course the main line and more affluent suburban areas like out in Bucks County. And by the way, if you think that's Philly, I had this map for DC. It's not in this presentation. I'm sorry, but for every $1 million home sale in Philly, there's about $3 million home sales on the main line. But for every $1 million home sale in our region, there's about $10 million sales in the DC metro area.
Same square footage.
Roughly, yeah. Actually, the city is smaller than Philly. DC, the metro area is about comparable. But there was a question? Yes, ma'am.
Yeah. Would Section 8 be a reality for many people in the future because these
In Philly, about 60,000 households,
So,
yeah.
And, you know, you have houses in Philly, I think it was 250.
270 is the median right now, yeah.
See, maybe Section 8 would have to mean the house.
Well, it's an option, but, you know, Section 8 is a federal program. It may be, it's locally managed and administered, but it's federally funded. Does the current occupant of the White House or Congress strike you as someone who's friendly to Section 8 funding right now? I wouldn't bet on that. At least, not for the next few years.
So you would have people living with their parents longer.
Yeah, and the people that are aging out of their parents, those are the ones living in these upscale new apartments, insofar as they can afford it.
And you have a lot of roommates, people that's.
That too, they're living, they're cohabitating till longer than they used to.
And one other question, during the pandemic, there were houses that were built during the pandemic. I heard that it's best not to buy in those houses because they were using cheap materials because, you know, the materials weren't coming from, I guess, from China or where they were coming from. So they were relying on cheap materials to build houses to 2020 to 2023. And I heard that some of them homes are structurally coming apart.
I have not heard of it. I wouldn't be shocked by it.
About the house, not to buy any houses built during that time.
Well, one thing I will say in Philadelphia's defense is that our building code is stringent, which adds to our construction costs. But the plus side is that the L&I is pretty tough about enforcing it, especially in, you know, if you're not a completely depreciated, foregone, you know, if you can still be saved as a property, they'll enforce it. So I haven't heard as much about it. I'm not saying it doesn't happen, but I haven't heard or seen as much. Any other questions?
Yes.
Oh, I'm sorry.
$280 square foot, was that based on the union cost or just cost in general?
The price per square foot? No, those are prices. That's what people are paying for homes, not the cost of construction. But I'm saying, you know, $280 a foot. I mean, to build a new home in Philly, let's take an apartment, you're probably looking at about $400 a foot all in if you're going to build, you know, 25, 50 units in Fishtown.
And
All
I
right.
just wanted to add to what the lady was saying. So the average age, according to the National Association of Builders now, the worst ever in the history of America. Is
For home buyers, first-time home buyers, that's right.
Yes.
Yeah, the average age of that people buy their first home has been steadily rising since COVID because of the affordability problem. It used to be 28 was the average age of a first-time home buyer. Then right after COVID, it was 32, and now it's up to like near 40. By the way, that has implications beyond just the housing sector because there's tons of research in the academic literature showing that home ownership is good for a society in general, for the very simple reason that homeowners have a stake in their communities that renters don't, right? They have skin in the game. So, you know, you've heard the old saying, you know, you don't shit where you sleep. Well, you know, when you own a home, you are basically, from an economic perspective, we view that as basically you become a shareholder in a community. So you know how if you buy a T-bill, right, it's a bond, you pay some money, and then you get a stream of coupon payments over time. If you buy a stock, you get a share of stock, and you get a stream of dividend payments over time, and then eventually you sell the stock. Well, when you buy a house, you pay property taxes, and you get a stream of public services over time, school, fire, police, right? So when you are paying for those services, because you're using them, you've got kids in the school, you care about the safety of your family, you care about the cleanliness of your neighborhood, as opposed to when I was 25 and single and I didn't care about any of those damn things because I was unbreakable and I had no kids. But you care about those things when you become a homeowner, right? So you go to school board meetings, you go to community meetings, you vote more regularly, you pick up the trash in front of your home. Just think of it. You've got two identical neighborhoods that are the same in every single way. It's just that one of them is homeowners, the other is all renters. Which one do you think is going to be the better maintained neighborhood? So if we become a community society of renters, I mean, that's going to have bigger implications about just our whole civic fabric, about how invested we are in our future, how much we care about the country and the society going forward. I mean, because renters, if you don't have a stake in the game, what do you care, right? I mean, again, when I was 25, I was kind of a jerk. I was a student. I rode my bike everywhere. I banged the hell out of the hallways every time I brought my bike in and out of the apartment because it wasn't mine, right? Now that I own a place, no, I don't. So,
I got one other question. Transient, how do you feel about, transient housing, which would be near L's and that type of thing? Do you have any thoughts on that?
then you get into the subject of the homelessness. Thankfully, our problem here, our homeless problem tends to be more driven by addiction than high housing costs. like in some other markets, like particularly the West Coast. But then you get into the issue of how to deal with mental illness and addiction problems, and that's a whole another thing. You know, we want to keep people sheltered. I can tell you this, as a fact, it costs $21,000 a year to shelter a homeless person in Philadelphia in government housing. It costs $85,000 a year to incarcerate a Philadelphian in prison. So it's way cheap. People complain, why should I have to pay to shelter homeless people? It's cheaper to give people shelter than it is to put them in prison, if that's the alternative, okay? Because a lot of people, you know, homeless people are mixed up in illicit activity. So that's something to keep in mind. But the problem is, it's NIMBYism. You know, transient housing sounds good to get the homeless people off the street, unless, of course, you're the one living next to the transient housing, which people hate. Okay. Yes, sir.
The price of a house, is there any correlation with the real estate taxes that the city charges?
Not as much, no. Because again, we don't, tax assessments, that's a huge issue in the burbs. People show up to moan about and complain about tax assessments all the time. I mean, they'll even take their town to court over, you know, violating the state's uniformity clause and all that. In the city, it's not so much an issue because the city doesn't really rely on property taxes that much. It does happen, but it doesn't distort our market as much as it does in the suburbs.
So there's no graph you have that shows real estate taxes rise faster than the price of houses.
I was showing that house prices rose faster than incomes.
No, I know you did that, but I'm saying you have no other graph that would show.
Typically, tax revenues chase real estate values, not the other way around, right? They set assessments to keep up with values, not the other way around. So usually assessments are behind where the market is at, but usually by about 6 to 12 months. Well, occasionally then you'll get like a big jump in assessments, right? They'll wait several years and then reassess an area. But again, that's separate from where the housing market is going. Yes, ma'am?
So I have a property here in Germantown which is zoned for a triplex. So just a ballpark figure, how much would it cost to build a new structure?
You want to build a triplex?
I will certainly do.
Okay, so brand new, yes. And it's all new construction. This is a single family. Is it attached or detached?
No, 3 families.
Three families. I'm sorry, I'm thinking just 3 stories. All right. So 3 units. Is this a house or an apartment? It's an apartment building?
An empty lot currently.
But I mean, the type of structure you're going to build.
I would like to do 3 apartments and to house veterans, so if I could factor in 2 bedrooms, 2 baths, could be small, and the property is like 1,800 square feet, so.
Yeah, I mean, all in, I would think you're looking at a development cost of probably around $350 to $400.
That's okay.
Okay. Yes. Could you speak up, please? I'm saying it doesn't drive our housing market. I'm saying it's relevant to homeowners, but as far as fluctuations in our home sales and house prices go, assessments aren't a huge factor. Not as much as interest rates and population movements and things like that.
So what I'm noticing is that there's a lot of properties in Philadelphia with back taxes. I think the last report was like over $100 million in back taxes, which that could alleviate a lot of the deficits.
Yes.
Why is it not being
Because unfortunately, a lot of those delinquencies are on paper. So remember when I talked about taxing people on income they haven't even made yet? A lot of those taxes are delinquent on properties that aren't correctly assessed. So these are abandoned properties. And so yeah, a person may owe money on them. That person is dead or they're retired in Arizona. Good luck trying to chase them down. And you can seize the property, but again, it's abandoned. It's probably, and the reason it's abandoned is because it's probably not in the most desirable location or neighborhood. So then the city can auction it. But remember, to foreclose on a property and take it to auction by sheriff's sale costs the city money of the procedure. So if the money they're going to recoup from that isn't enough to cover the cost of foreclosing it and getting the title transferred to the city and then auctioning it off and getting title transferred again, they don't bother. So that's why you see so many abandoned properties just sitting vacant in the city. And you can't redevelop them because, again, our cost of development is so high. So they're just dead assets on our balance sheet, unfortunately. I'll tell you one thing. If you go to San Francisco or the Sun Belt, you don't see any abandoned properties, okay? Or even vacant land. That stuff gets snapped up fast. But here, you can get away with it. The demand is not there and our fundamentals aren't there.
When you say
Then you get into the political issue of Sheriff Rochelle Bilal. The sheriff's department is in charge of foreclosures and sheriff sales. She's not the most well-liked person in city politics, and not known for playing well with others. So, but then you get into, that has nothing to do with our housing market. That just has to do with Philadelphia politics. I want to answer more questions, but I also want to finish too. Do you want to?
I was just gonna say, just when you finish, can you just quickly touch on the housing bubble topic? Like any, like takeaways, are we in the bubble or we're not in the bubble? I know you said you were gonna skip, but once you finish.
Sure. Let's do building permits, then we'll do the bubble very quickly. So this is the number of new units that have been approved in Philadelphia, going all the way back to 1990, okay? The black line is the population of Center City. The green component is the number of multifamily units and apartment buildings and condos that have been approved. Purple component is the number of single-family homes that have been approved. Notice that up until 2000, in a city of 1.6 million people, we were only building about 500 new housing units per year. And the population of Center City was flat. What happened in 2000? Anyone want to guess? Two things. Tax abatement? Who said that? You did? That's right. And then the other thing was Center City started to revitalize. Okay? So we started building more units. Now this huge spike you see here, that's the changes they made to the abatement in 2021. Basically they cut the value of the abatement in half because they thought it was a big subsidy to like wealthy condo owners and developers. That big spike is basically every home builder in Philadelphia running to City Hall at midnight on New Year's Eve, trying to get their building permit approved before the changes to the abatement took effect. But if you took away this spike, which completely skews the graph, you can see the boom of the last few years, and then you can see how recently new home building in the city has tailed off because we're trying to absorb a lot of those new units, okay? All right, so you asked about the bubble. Are we in another bubble? Short answer, no. That doesn't mean we're not gonna have a downturn. It's just not gonna be a crash, at least given where our fundamentals are. Number one, here's our mortgage delinquency rate in the US. This was our mortgage delinquency rate prior to the housing bubble. This is our mortgage delinquency rate during the Great Recession. Here's where we are now. Delinquencies are very low right now, okay? So when delinquencies tend to be a leading indicator of a housing downturn. If I see delinquencies rising, that means foreclosures are gonna follow, and that means they're gonna take the housing market with it. We're not seeing that yet. Number two, credit scores right now for borrowers are much, much higher than they used to be. This is during the housing bubble years. See the red components here? These are mortgages that had very low credit scores, borrowers with very low credit scores. See what a big percent of borrowers were back in the 2000s, had low credit scores? All right, and then they lost their homes because they were over leveraged. See the blue component, how big that is today? Those are people with credit scores over 760. So the people that are borrowing today, this is where we are right now, have very high credit scores. So they're not as leveraged, and they're much more creditworthy right now, the current home buyers. Another thing is that the loan-to-value ratio for all outstanding mortgages in the US is very low right now, meaning home ownership equity is very high. So if we take back in 2013, during the Great Recession, if we took the dollar value of all outstanding mortgages in the US and divided that into the value of all the homes secured by that mortgages, we would get 70%. Meaning back in 2013, the typical US homeowner had 30% equity in their homes, meaning that house prices would have to fall 30% before you are underwater on your home, meaning you owe more money than the home is worth, okay? Now that happened. For example, in Las Vegas during the housing bubble, house prices fell 40%. In Arizona, Florida, they fell 50, 60%. So even 30% equity in your home was not enough to guard you against a downturn. But right now, the ratio is around 45%, meaning house prices in the US would have to fall 55% before people would start defaulting and becoming underwater. Now, if house prices fall 55%, okay, you're not gonna have to worry about your equity position in your home. You're gonna have to worry about where to get your hands on some ammunition and bottled water, all right? So we don't have nearly the risk exposure right now that we did roughly 20 years ago to a downturn in house prices. Lastly, price to income ratios are much more stable right now. I'll skip that one. The Federal Reserve keeps a list of problem banks. These are banks which are starting to see rising foreclosures, rising delinquencies. They're overextended on their credit. They're lending too much money to too many risky borrowers. Back in the Great Recession, notice that this list of problem banks started to rise back in 2008. By 2012, in the depths of the recession hit 900. Look where we are today. So the banks are also in much, much better position right now. They're not nearly as exposed to a housing downturn right now, all right? So, could we have a downturn? Yes, but I don't think we're in a bubble. If we have a crash, it's going to be because it's something outside of housing that happened. I mean, something international. China invades Taiwan. Putin does something. Trump does something. I don't know. Pick something. But I'm saying the fundamentals of housing support a soft landing right now. All right. So where are we going to go from here? That's what you really want to know, right? So let's talk about interest rates. Do you ever wonder when interest rates are going to come down? You get asked this a lot or wonder about it. I'm going to tell you how to predict interest rates. Believe it or not, I'm actually a former employee of the Federal Reserve. That was my first job after college in Washington. I used to ride the elevator with Alan Greenspan. And yes, he's every bit as charismatic in person as you remember him being on TV. So I'm going to show you how to predict rates. So this is the 30-year fixed. I showed you this chart already. Now I'm going to add in the University of Michigan's Consumer Inflation Expectation Survey. The University of Michigan, as part of its survey of consumers every month, asks them about their inflation expectations. How optimistic or pessimistic are you about your personal financial situation? And also, how optimistic or pessimistic are you about the prices you expect to pay in your own life for the next year? How much do you expect them to go up? Okay? 2% is the magic number. That's what the Fed looks for. When inflation crosses 2%, the Fed becomes very bearish and pulls back on the economy and starts hiking rates. When inflation drops below 2%, then the Fed feels comfortable in lowering rates. So let's look at inflation expectations, okay? So let's go back to 2016. See the green line? It was around 2% back then and started to rise. What did the Fed do? Raised rates, right? Let's jump forward. 2019. See how inflation started to go down, inflation expectations to 2%? What did the Fed do? Lowered rates, right? Jump forward. COVID, the recession of 2020. Inflation really dropped because we hit a recession. The gray area is the recession, the COVID recession. What did the Fed do? Drop rates. But then, 2021, what happened? Biden-inflation, and yes, he did have a lot to do with it, I'm sorry. Look, inflation expectations crossed 2% and started to really go up. What did the Fed do? Raised rates, right? Jump forward. Where are we now? So inflation has leveled off. It hasn't dropped, but it's leveled off. It's at 3%. The Fed wants it at 2%. So we're still well above 2% by the Fed's standards. Are we seeing much of a drop in rates? We've seen a little easing, but not much, right? Watch that green line. This is available online. University of Michigan Consumer Inflation Expectations. Just Google it. You'll find it. It's free. Watch that green line. When that starts to drop down to 2%, you can become bullish on interest rates. And the Fed will start making some moves, okay? Start applying for some loans. See? So if you ever get tired of this whole real estate thing, you can all move to New York and become bond traders now. Make a fortune that way. You're welcome. All right. What else can you expect? How about, yes, sir?
So is it the change of chairman in May?
Yeah, again, that's a political question as well. I don't know who, if that person's going to become chair, if they're going to play ball with Trump or maintain their independence. Good question. I can tell you the employees of the Fed aren't privy to that information. All right. So how about the probability of recession? Anyone here worried about a recession? So we know the market's softening. We see some indicators in the economy. But let's see where we are. So one of the best leading indicators of a recession is called the Sahm rule. It's named for a woman, an economist named Claudia Sahm. She works at the Federal Reserve. And she found out that when the unemployment rate has several consecutive months of a sharp uptick, that's a leading indicator of a recession. People start to get laid off before a recession hits, right? So she measures in this index how many cumulative months of increases in unemployment we've had in the US. And when that starts to go up, it usually indicates we're going into a recession. So the gray areas are all recessions in US history going back to 1960. Look where the blue line starts to go up. 1960, recession of the early 70s, here's the inflation, recession of the mid-70s, recession of the early 80s, recession of the early 90s, tech bubble and 9/11 recession, housing bubble recession, COVID, here's where we are now. So at least as far as the labor market numbers go, we're pretty stable. We're not looking at a recession yet. By the way, the silver lining of a recession is that it would give the Fed an excuse to cut rates because prices tend to drop during a recession because the economy cools off, right? So that's another positive thing to be grateful for. I mentioned inventories. These are also a very good leading indicator of the market. This is the supply of homes listed for sale. Inventories tend to rise and fall before house prices and home sales do. That's why we like to watch it. So this is the number of homes listed for sale in Philadelphia going back to 2001. In any given month, there's about 5,000 homes listed for sale in Philadelphia, in our city, okay? When that number starts to rise above 5,000, it tends to indicate cooling in the market. So see how low inventories were back in 2004, right? The market was white hot, but they started to climb back in 2005. But house prices didn't start to decline until 2008. But inventories were rising. Well, remember, supply and demand. All else being equal, if the supply of something starts to increase, what do you expect is going to happen to prices? They're going to go down, right? Inventories are the supply of homes. Also, in addition to new home building, is the other measure of home supply, okay? This is the supply of existing homes. The housing permits are the supply of new homes. But when both start to rise, you can typically expect a cooling in the market. So we hit bottom back in 2021, all right? We had only 3,000 homes listed for sale here in the city compared to our historic average of 5,000. They've been rising, but we're still below average. So this is helping a bit, which is why we've seen some amelioration in prices. I showed you prices, house prices are starting to level off. That's in response to both higher rates and inventories coming up. But this needs to come up a lot more before we see any significant cooling in prices and buyers get back into the market, because the affordability issue is such a constraint to them right now. The more supply you add to the market, the more choice you give people, and the more of a cooling and moderating effect it will have on prices. So watch that as a leading indicator of the market. Another thing I like to look at is Philadelphia not only tends to lag the national indicators in terms of the cycle of our fluctuations, we also tend to lag other metro markets in terms of our housing movement. So another fun little trick I'll let you in on, if you want to know what's going to happen to Philly's housing market, look at what's happening in the Sun Belt and then extrapolate that forward 6 to 12 months. I'm not kidding, it works. So this shows active housing inventory compared to pre-pandemic levels by metropolitan area. So orange areas are areas that still have very low inventories. So there's still upward pressure on prices because supply is low. The teal, aqua areas are places where inventories have come up and hence prices are now moderating or even falling. So where do you see the cool areas of the country? It's the Sun Belt, right? In the West. The areas that are still experiencing low supply and price increases, the West Coast, the Great Lakes, Rust Belt, and then the Northeast. That's Philadelphia right there. That's New York, that big circle right there, okay? So all these bubbles that are green down here, expect to see them start drifting up and these to eventually turn green over the course of the next 12 to 18 months. So again, another leading indicator. We're not in a housing downturn yet. We're seeing leveling off here in Philadelphia, but we haven't officially entered a cooling phase or a contractionary phase yet. But like I said, I expect it to be a fairly modest contractionary phase. We're not nearly as overbuilt or nearly as over-leveraged or overextended as we were 15 years ago, okay? And then if we zoom in, you can see Philadelphia right there. Our inventories right now, even though we're up off our base, they're still 41% below our pre-COVID level, and it's below the national average of minus 21%. So we still have a little ways to go to get back to a balanced market. Month supply of inventory is another one. This is how many months it takes to burn off the current inventory of homes. You want between 5 and 7 months of supply. That's considered a balanced market, meaning that buyers and sellers have no leverage over each other. They're in parity with each other, okay? Typically, when you're in a balanced market, prices should be flat. They should be going sideways because neither one has any leverage over the other buyer or seller. When you have more than a 7-month supply of homes for sale, that's a buyer's market because supply is so big, it gives buyers the leverage. They've got the choice, right? You're competing with a lot of other sellers in that market. When you are below 5 months inventory, then you're in a deep seller's market. Then when there's upward pressure on prices because sellers are dominating the market, they get to command what you're going to pay. So month supply bottomed out back in 2022. Inventory has started to come back up. So we're seeing some moderating pressure on house prices, but we're still in a seller's market. So sellers still have the upper hand, but it's not as strong an upper hand as they did 2 or 3 years ago. And I expect this trend to continue. But inventories tend to move very slowly. I like to say that it's like an iceberg. They don't turn on a dime, but once inventories start to trend in a certain direction, it's like when an iceberg moves, it's very, very difficult to stop it. It tends to have a lot of momentum. Even if that momentum, it doesn't have a lot of speed, it does have a lot of momentum to it. So I expect to see that trend continue. So further cooling in the market. Apartments are predicted to remain flat in terms of prices while we absorb it. What are house prices going to do? Zillow publishes a 1-year forecast for every metro market in the country. Right now, Zillow is predicting that house prices in the U.S., this is my house prices in Philly. This is my house price index for Philly. The dashed line is Zillow's forecast for the next 12 months. They're predicting house prices in Philly will grow by 1.2% over the next 12 months. What do you think of that number? Is that good? Bad? Neutral? Don't know?
Said it was 4.5.
That's exactly what I was aiming for. Remember, 4.5% is our average. So Zillow's not predicting prices to decline, but they are predicting us to underperform. So we're going to have a cool market, but not a contracting market over the next 12 months, at least if you believe the economists at Zillow. I think they tend to overreact a bit to whatever the latest information is. Their forecasts tend to always overshoot, either up or down. But I'm inclined to lean their direction on this one, in that all signs are towards a cooling market, but not a collapsing one. So their forecast is becoming increasingly bearish over the course of the past year. And for context, like you said, our average appreciation rate is 4.5%. So a cooling market, but not a contracting one. What should you expect going forward? So these were my previous predictions for 2025. Absent a recession or trade war, I think rates will remain largely flat. Expect them to drop somewhat as the tariffs increasingly start to bite. Apartments are still dealing with the glut of new construction. Offices are still dealing with return to work. There's a lot of debate right now over the abatement and how to modify it. Maybe they're considering extending it to 20 years for the conversion of old Class C and B office space to residential space, which I would be in favor of, because we don't know. No one wants to rent Class C office space that was built in the 1950s. The utilities are expensive. It's not pleasant space. The windows are too small. Young people these days want amenitized offices as much as they want amenitized residences as well. Just going into a cubicle every day and just an office and the only amenity is a coffee shop in the lobby is not cutting it for young people right now, okay? Quick anecdote I can share. If you talk to the commercial brokers, they'll tell you that prior to COVID, if you rented Class A office space in Philadelphia, I'm talking primo office space in Center City, you know, Comcast Tower, Liberty 1, Liberty 2, places like that, the Sears Center. You rented space like that because you wanted to impress clients. That's what you were paying for. If you're shelling out $55 a foot, which is what rent used to be in, you know, the Sears Center prior to COVID, it's because you're a law firm and you bring people in. You're a lawyer who charges $1,000 an hour. You better look like someone who's worth $1,000 an hour. Since COVID, the reason people are renting Class A space is not to impress clients, it's to impress young employees. Get them off their butts out of their suburban apartment and get them into the office. To do that, they want amenities, okay? If you think giving them a cubicle is cutting it, forget it. They want a private office. They want free bike parking. They want a break room that has free coffee and a Keurig and all sorts of gourmet things you can add to that coffee. They want a cafeteria with subsidized prices that has locally harvested, organically sustained sushi and produce. They want a yoga room. They want a meditation room. You know, add to the list, okay? Private bathrooms as well as transgender bathrooms. Go down it, okay? But believe it or not, you wouldn't think young people have the leverage. I deal with young people all the time. I teach them. They're very pessimistic right now about their outlook. They don't realize that they actually have the leverage right now in the office market. It's 65-year-old guys who are millionaires that are paying money out the butt right now to get 25-year-olds off their butts and back into the office. So that dynamic has changed as far as office space goes. But let's get back to residents. But we get the young people back in the city. That will also help the city's housing market. There's currently greater support for house values than there's apartment values. We haven't built a lot of houses, so we don't have the problem absorbing that inventory, but we are absorbing a lot of the inventory from the new apartment construction. So I expect the apartment segment to remain softer than the single-family housing segment. Inventories will continue to slowly rise. I think sales will remain largely flat or steady until we see rates drop down. As I like to say, I don't think housing is not entering a contractionary phase, it's reverting to its mean. So we had an upcycle, and we're just reverting to our long-run trend. Okay, so cooling but not collapsing. But then there's the Trump factor. It's difficult enough to try to predict what the economy is going to do. I'm not going to try to predict what Mr. Trump is going to do. But here's the life plan that I show my students now. This is what it looks like if you're a young person right now in America as far as home ownership goes. By age 35, you pay off your student loan. Age 75, you pay off your mortgage. You sell your house for your home care fees, and then you die. God bless America. Thank you very much. And if you have any questions, I'd be happy to take them. Thank you.